let's get started. The visitors today who are like, oh, yes, okay, sorry.
Scott Fitzpatrick. He came in from Findlay, Ohio, and he's an internal auditor / financial analyst with a radiation
Environmental remediation.
Here's another problem session, Sunday at 7 p.m. This time there won't be any mix-up in the room. I was guaranteed classroom B, and nobody to open it up. So I haven't got the classroom confirmed yet, but there will be somebody to open it up this time. Midterms on Monday, correct? Okay. So what we're going to do today is finish up options. I'll talk a little bit about futures if time permits. And then I want to go through last year's midterm exam, which I've got the solutions for up there, and also the next handout for futures. You don't need to get that now because we're not going to be talking about it until the second half. But I do need an hour, I think, to get through the 2.5-hour midterm exam from last year. 2.5 hours. Well, yeah, of course. It turned out that the lecture that I was doing for that course was a 3-hour lecture, so I made it 2.5. So this year it won't be a 2.5-hour exam. Okay, well let's continue where we left off with the Black-Scholes formula. And what I wanted you to do to kind of stare at this thing and try to squeeze out any reasonableness that it might have. That's what I really want to start with today, and then when I'm going to start to use it today, some applications. Okay, so notice this is the corrected version of the formula that I posted right after the lecture, where it's got the stock price minus the present value of the dividend. So anytime there's a stock price, you subtract the present value of the dividend. And what we did right at the end of last lecture was to notice that if we assume the dividend was 0, and if we got rid of the NX1 and the NX2, then it says that the call price today is just the stock price minus the present value of the exercise price. And that's very similar to the sort of basic formula that we had, not even a formula, it's almost a definition of what the call is worth at expiration. At expiration, the call is worth S star minus K. We're not at expiration, we're today. So we take the present value of the exercise price, which is PVK. We take the present value of the stock price, which is the stock price today. And if there's a dividend, we take the present value of it, and that's where the present value of the dividend actually gets in. So we've got S minus K as the price of the option. But, yes?
The present value of the dividend, is that an annuity or is it just you treat it as something?
It's the dividend over the life of the option. Usually the option is short-lived, like 3 months, so it's maybe one dividend we have to worry about. If it's a longer-term option, then it's a stream of dividends. Now, S minus K isn't that satisfactory of a formula for an option. Okay, you think about it. The strike price is 100, and the current stock price is, let's say, 105. I suppose that's the scenario. So as a call option, you've got the right to buy at 100, but the current stock price is 105. Now, if we just use this S minus K formula, it would say that the price, and ignoring even the present value operator, price is like 5. Well, we know it's got to be worth more than 5 because there's this chance that the stock price is going to go even higher. Okay, so we need to incorporate these probabilities as to where the stock price is going to go into the formula. And that's all these cumulative normal distributions actually do. And so what I want to do, without actually plugging into the formula, is to kind of look at these x1s and x2s and try to see if they're doing things that are reasonable. Okay? Suppose that S is far above K. So the current stock price, I give 105 and 100 for a strike price. Suppose it's like 200 and 100, way above K. And suppose that we've got, a year to go, so T equals 1 and 20% volatility. Okay. So approximately, what's the value of this this ratio? So current stock price 200, exercise price of 100. Talking like in around 2. More than 2 because it's present value of the exercise price. So that's 2. And we take the log of that. So the log of 2 I can't do in my head, but I know it's above 0. 0.69. 0.69. Okay, 0.69. And then I'm taking that, dividing by 0.2.
3.46.
3.46, and then I'm adding something small, half of 0.2.1. Okay, I'm adding something small. So 3.46. So what's the cumulative normal probability of getting a value of up to 3.46? 1, basically. And does it matter if we add 1/2 sigma root t or subtract 1/2 sigma root t? No. So basically, what it's saying is that the nx1 and the nx2 are basically 1. So what this formula is saying, that when the option is way in the money, which means that the stock price is way above the exercise price, that the Black-Scholes is telling us that the value of the option is like S minus the present value K. Okay. Yes?
Could you review those numbers again on the chalkboard and where they would fit with this equation?
Yeah. So this would be current stock price is 200. So that's the numerator. The denominator is the present value of 100. I said it was a year to go. So let's say a 10% interest rate.
I'm sorry, could you stop? The whole numerator is 200? It's not just S.
S, because I'm assuming the dividends are 0.
Okay.
Okay? So S is 200. This is an extreme example. And I didn't mean to be precise in terms of the actual numbers. S is 200. PVK is, let's say, 90. So we get something greater than 2. Take the natural log, and it's 0.6 something. I assume that T was 1 year, and sigma was 0.2. And sigma is the annualized standard deviation. So 0.6 something divided by 0.2. And that was like 3.6. And then add 0.1 to 3.7. N of 3.7 is approximately 1. It's 0.99999. So it's saying when you're way in the money, the call is basically S minus K. And go to the paper and check it out. It's an easy one. It's an easy one because you can basically ignore the present value of K if it's like a 2-month or a 3-month option. And you're going to find that the call is approximately S minus K. Yes?
Does this formula only hold for calls? I mean, what about, what do you want to do? Do you want to add value or what?
Good question. Black-Scholes is all presented in terms of a call. So let's say we've got like an Amgen 45 for January, call option, okay? And an Amgen 45 January. January put option. Okay? And actually, we want to find the price of the put option. But the Black-Scholes is a call option formula. What do we do? Minus? So the call option, let's say, is worth $4. Put option is not -4.
You just plug it into put call parity.
Plug it into put call parity. Because if we do this, we get the value of the call, we know the value of the stock, we know the present value of the exercise price, we know the present value of the dividend if it exists. We know by no arbitrage that the puts and the calls must be linked.
But, I mean, in reality, if option traders are using this formula and there's, you know, the bid-ask spread is off or something like that, and there's an arb opportunity in the put, you're never really going to find out because once you do that, you're assuming put call parity, which actually doesn't hold.
The put call parity always holds. Now, what you're saying is that because of the bid-ask spread, you might appear to get a violation of put call parity, but that's taken into account. That's why you don't arbitrage like 8% deviation. So that's definitely taken into account in the program data.
So if we're doing our portfolio, that's the way we do it. If we're trying to do this for.
Exactly.
And then one quick other question. Can you get how do you find out if your stock has dividends? Can you get that from the paper, or do you just have to go to something else?
Yeah, I believe it's in the paper, but there's better sources for it, like S&P reports, or there's a lot of reports in the library that could be helpful for that. Yes?
Can you back up? Did you say that if the option is way in the money, the value of the option is just S minus K, or is it S minus the value?
S minus present value. But it's going to look like S minus K if it's like 1 month ago. If it's way in the money. Now, what about if it's out of the money, which means that the S is below K. So our example, K is 100. Suppose S is something like 89. Okay. So it's out of the money. It's 1 year to go. And let's fix that screensaver. S divided by the present value of K. And I said the present value of K was 90. And let's say S is 89. That's less than 1, right? What's the log of something less than 1? Negative. And then what happens when we divide a negative number by something that's real small? It's going to become more negative. Okay? And then we're going to add a little bit to that negative number. So it's going to be a larger negative number. And let's say it's the x1 that we get is -1. Suppose that's the case. Then we go to the cumulative normal distribution. And what's the probability of getting a value up to -1? Can't tell in my head either. -1. Yeah, 3 or something like that?
32.
Something like that. So 0.3. So now the NX1 and the NX2 are, let's say, approximately 0.3. And we get the value of the call from that. So we're applying something different in that case. Okay, so basically what we're doing is applying something that kind of represents the probability that the call is going to finish in the money. That's what all this normal distribution stuff is doing. And obviously the probability is affected by where the current stock price is compared to the exercise price.
If x equals -1, is it 0.15?
X is -1, say it again.
You just said that x is -1, and then we said it's 0.3, or is it 0.15?
Actually, I need to look at the normal distribution within 1 unit, I believe, is 66% approximately, right? So I think it's like about 0.3 is the area up to -1 on that distribution. I think that's right. So
That'd be 0.15, 0.15.
But it's all up to that.
it's up to the point.
You
So
don't have tails on both sides.
I don't know if this plastic's got chalk. Haven't used chalk in years. So we've got the distribution, and it's,
A little dark.
let's see, so there's 0. So this is 50% at 0.
Can you make that a little darker?
Can't see it. Okay, normal distribution in that. So up to 0 is 0.5. And we had previous example like 3.6 or 3.5. Okay, so the area up to here is 0.999. Okay, and now the question is, what's the area at -1? And I think that that's about 30% or 0.3. And you could consult the normal table, or maybe somebody's got a calculator that could do it exactly. But it's about 0.3. Correct? So, as I say, we're not going to be guessing. We're going to be using a computer for tables to do this.
Cam, I think, isn't it 0.5 minus 0.3 though? Or 0.33? That's the area? So it would be 0.17 or...
As I say, I actually, I don't know the exact number.
But it would be 0.5 minus whatever that...
I might actually have a table on me. So it might be less than 0.3.
Yeah.
Yeah. I'm not real good at these things in my head.
I'm thinking half of the 0.66 is on the left-hand side.
So it's going to be like 0.2 something. Yeah. Okay, so
The Excel does that for you.
What happened there?
cumulative normal distribution. Okay, so the area, I've got a cumulative normal table here, and the area up to the value of 1 is 0.84.
That's positive one.
Yeah, so like up to 1 is 0.84.
So it's 0.34 to
Right,
this
so
side.
then really what we're measuring is kind of the other side because it's symmetric.
Right.
So this could be 0.16.
Right, yeah.
Okay, good. So, everybody see that? So I just pulled out a normal table and asked what the area was up to the value of 1 because it only gives positives. Okay, so how much of the curve is up to 1? And it told me 0.84. And I know what I'm interested in is this portion here, but I know this portion is exactly equal to this portion. Therefore, it's 0.16 is the area up to -1. Okay, again, you know, it's probably more important to you know, be able to hit this in a calculator. This is not something that is critical. Okay, well, let's continue with this. And so this is the basic formula. I make another stab at the intuition behind the formula, which is for your reading. It's not. It's basically saying the same thing. Let's go to some examples. Okay, and we're going to use some tables for this. And these tables, as I say, are available at the back of last year's midterm exam, and it will be available attached to this year's midterm exam also. So you don't have to worry about memorizing the tables or yes.
This is kind of a basic question. Let's say I throw all these numbers, I do the calculation, I find out, gee, my value is less than what I paid for it, or maybe it's more. But my question is, okay, then so what? I mean, I know that it's calculated less, but these prices are, all of them are constantly changing, so how do you address that?
Well, you got it running in real time. So the screen is telling you what the price should be. There's an actual price in the market, and people decide to trade on it.
Okay, but what about for someone like me in our
You have to know, you know, like if the option is offered at a certain price, it's probably the fair price for you, like an exchange trade option. But the option isn't trading. You need some idea of what it's worth. If you're, you know, within a corporation, you're thinking of issuing warrants. You need to know how to price them. You can't look them up in the Wall Street Journal because they don't exist yet. Or you're thinking of doing an over-the-counter option that isn't traded. So you need an interest rate option overnight or something like that. You need to know how to go about in pricing. That's what we're doing. So this is a theoretical formula that gives us a model price, and that's real important. It's only a model price. Black-Scholes formula is one of the more popular models. It's not always going to be correct, but it's a pretty good approximation. So it gives us a sense of what the price should be rather than what the price actually is, and there could be a difference.
Then my next question is, okay, let's say I'm pricing some warrant or something that's not traded. How are you going to know the standard deviation that's not traded?
What the warrant isn't traded, right?
Well, let's say
It's
we're
the standard deviation of the underlying stock return. The stock can be traded. Okay, that's important. The standard deviation is a measure of the volatility of the underlying asset return, whether it's a bond or a stock, depending on what the option's on. So, but you're correct that you need to have a view of what that is from now to the end of the option. Okay, so you might have historical data on the stock returns, which could help you with that, but it's really a matter of the future. Yes?
Could we also calculate sigma from the stock prices that we see for the assignment? If we recollect data from today up to 20-something, and then we will have, let's say that the option doesn't trade, so we have to calculate the price. Can we take sigma from the historical data, like deriving sigma from the prices of the options?
You can estimate a sigma with historical data. Okay, so you calculate stock returns based upon the prices, stock prices. You can calculate a standard deviation, but all I'm saying is that's not necessarily the standard deviation that people are using to price the option, because the option is based upon the forecasted standard deviation. What you're measuring is a historical standard deviation.
And if we derive sigma from the call prices that have been...
That is forward-looking, and we're about to do an example of how to do that. Okay, so what we're going to do is we're going to back out the volatility from the current call price, and that's going to be forward-looking. Okay, well let's do some examples. So find the value of a call option IBM. Exercise price of 260. This is an older example, obviously. And time to maturity of 2 months. Assume the current price is 265. Annual standard deviation is 30%. Dividend yield is 4%. And riskless rate of interest is 7%. Okay, so it's got a dividend here. And I'm going to make a simplifying assumption. I'm going to assume that the dividend yield is like a continuous dividend yield. But you'll see how I do that. So it says value the 5-month call under the same terms. So if it's the same terms, should the 5-month be worth more than the 2-month, or 2 months more than 5? 5 should be worth more. If the current prices of the calls are $15.75 for 5 months and $12.12 for 2 months, then are these options overvalued or undervalued according to the Black-Scholes? So here's the situation. We're using a model. We're given the volatility. We're going to get a model price, and we're going to observe a market price, and we have to decide, based upon that, whether the options are overvalued or underdone. And what are the potential causes of the discrepancies? And what standard deviation is implied by the current price of the 5-month call option approximately? Okay, so this is a fairly long question. And so let's go through it. Okay. The first thing is to adjust the stock price for the present value of the dividend. That's basically what I'm going to do is go S minus PVD. In this case, I'm going to assume the dividend yield is continuous. And I'm going to use the formula e to the minus delta, and little delta here is 0.04 times t, and t is 2 divided by 12. This is 2 months to go. If you don't like this, then you could just do S minus the PV of D over, let's say the dividend was paid in 2 months. Okay. But this is just a quick adjustment that's often used in option pricing. So this is the adjusted stock price, and it's very close to the actual price. It's 263.24 compared to 265. The next thing we're going to do is compute the present value of the exercise price. So we're given the interest rate. The time to expiration is 2 divided by 12. Again, use this formula, e to the minus RT times K. That's 0.9884 times 260, which is the exercise price. And we do not get 263.
56.98. 98.
Yeah. Okay. That's 256.98. So let me make a note of that. I'll change that when we get back. Hopefully everybody can see that 0.98 times 260 is not 263. Okay, so these are the steps that we're going to go through to price this option. The first thing we're going to do, yes?
I have a question regarding the present value of K, because I tried to do it the other way and I didn't get the same number. I mean, I tried to do stock price minus the present value of the dividend.
It's going to be very close. No? It should be very close. So 2 month at 4%, what is 4% of 265?
10.6.
And then that's going to be over 2 months. So divide that again by 6. Discount that by the rate appropriate for 2 months. It's going to be very close.
Okay.
So we could look at the calculations. It's not going to make a substantial difference in valuation. Okay, so the first thing that we're going to do is to take the ratio of the ex-dividend stock price to the present value of the exercise price. So sometimes the adjusted stock price or ex-dividend stock price is going to be basically the same thing. Okay. And that ratio is 263.24 divided by 256.98, and that equals 1.024. Now we're going to be using tables to do this valuation, and it turns out that we're going to be looking down a column that is labeled the ex-dividend stock price divided by the present value of the exercise price. So this is going to be a column that we're going to look down. And step 2 is to calculate the standard deviation of the stock's return to the maturity. Okay, so sigma that we're given is an annual sigma. Well, we don't have a year. So what we have to do is to adjust that sigma for the fact that we've got 2 months. And multiply 0.3 times 0.4082, and we get 0.123. Is that the square root of 2? But I forgot my calculator today. Is that correct? So what is the square root of 2 divided by 12? That's correct. Good. Okay, the next thing is that we're going to go to the option tables. So these calculations, I think, are pretty straightforward. Sigma rho t, and this ratio of the adjusted stock price divided by the present value of the exercise price. This is going to be a column that we're going to look down, and the sigma rho t is going to be a row that we're going to look across. And we're going to match, we're going to go down the column, across the row, we're going to find a cell. And the cell is going to tell us the call value as a proportion of the ex-dividend stock price. Okay? So that's what we're going to do. And let's actually do that. There's a link here to the Black-Scholes tables, but I think I told you last time that it's going to be easier for me to actually put a hard copy of the table up for you on the overhead. So this is table 1. The call value is a percentage of the current stock price ex-dividend. And we're going to be looking, hard enough to see at this scale. But you should have this, as I say, tacked onto the back of that exam. So this is the second page of table 1. Let me actually slide it down a bit so I can reach it. I'm going down a column that's 1.024. And notice that these numbers go 1.01, 1.02, 1.03. So I don't have exactly the column 1.024. So I'll have to do a little bit of interpolation, but I know I'm going to be somewhere in between 1.02 and 1.03. This is the column I'm going to look down. Sigma root t is 0.123. And again, I don't have a 0.123, but I've got a 0.12 and a 0.13. And conveniently enough, there's, I don't know if you can see, this is the green dot here. It's about where I want to be. So all I'm going to do is kind of interpolate between these numbers. You don't have to be exact on this. Just don't take anything outside of these numbers. So if you take 0.5, there's no way to interpolate any of these numbers to get 0.5. It's 0.58, 0.63, 0.058, 0.063, 0.062, 0.067. And my guess is that it's like a 0.061. Okay? So just basically three things that I've done. Step one, adjust the stock price for the dividend, divide by the exercise price. That's the column I'll look down. Step two, take the sigma, multiply it by root t. That's the row I'm going to look across. Step three, figure out what the cell is. And the cell is the call price as a proportion of the ex-dividend stock price. So to get the call price, to back the call price out, I take 0.061 multiplied by the ex-dividend stock price, and I get 1606. That's the value of the call according to Black-Scholes. Now, I also ran this on the computer. Actually, did anybody run these on the computer? You did. It's close.
Yeah.
It's close. Using the table is pretty close to what you get if you did it exactly. All right. So that's how to use the Black-Scholes with tables. And let's do more examples. And let me assure you that you will have to go through this exercise on the midterm. Okay. So the more examples you can do, the better. And my lecture handout, that thing that you paid for, is just riddled with examples like this. And the more you can do, the higher your grade will be. Simple formula. Okay. So let's do another one. We're going to do basically the same thing, except now t is 5 divided by 12. Okay, so I'm changing the timed expiration. Is the call option going to be worth more than $16? Yes. It better be. If it isn't, then it may in there in the formula. So let's do that. Calculate this ratio of the ex-dividend stock price to the present value of the exercise price. It's now 103. Remember before it was 102. Calculate the standard deviation to maturity. That's also greater, which makes sense. There's more time. The t is greater. We're using the same 0.3, but we're using a larger t. Now we're going to go to the tables again and look down 1.03 and look across at 0.194. Let's do that. So going 1.03, I'm looking down, and I'm looking across at 0.194, which is down here. And again, conveniently enough, there's a green dot to guide my laser pointer. And I interpolate amongst these four numbers. Again, there's no formula for interpolation, and actually, I really don't care as long as you're within the boundary of those four numbers. So people always ask me, well, what is the formula for interpolation? There's none. You know, this is an approximation. We're using tables, right? Just grab a number within there. Don't worry about it too much. Okay, as long as you put your dot in the right place, you're not going to go wrong. And I said that was 0.093. So again, 0.093 equals the call is a proportion of the ex-dividend stock price. So multiply 0.093 times 260.62, you get 24.23, okay, which is good news. because it's greater than $16. Okay. And again, I verified this number with a computer program. This one was real close compared to the previous one, actually. Okay. And now, let's see. Are we currently valuing these calls correctly? And let's basically, in the question, it was given what the market prices were. And let's go and see what they are. The market price, the current price is $15.75 for the 5-month and $12.12 for the 2-month. Okay, now we calculated our own set of prices. So let's go examine those prices. So the 2-month is $12.12, and we calculated the price to be 16 or something, right? 1606. Okay, and so the current price is $12.12, and I think this is supposed to be 1606, right? 1583. That was pointed out to me before class. So basically, the market price is way below what we think the price should be. Why? Yeah, where did we get that 0.3? That could be the difference. That maybe we made a mistake on the volatility forecast. So is the market using a higher or lower volatility in assessing the price of the option? The market's using a higher volatility. So if we went to the Black-Scholes formula, and instead of using 0.3, we use, let's say, 0.4. What's that going to do to the Black-Scholes price? An increase, right? A higher volatility means a higher price. The 2-month option, we priced at 16 with a Black-Scholes formula with a volatility of 0.3. We used 0.4. My guess is that the value of the call option would go up to over $20. The market price is 12. So what's happening? Is the market using a higher volatility or a lower volatility? Lower. Got to be lower. Anytime there's a deviation and one is lower, the volatility and price go go the same sign. Lower price means lower volatility. And it's the same story on the 5-month option. So we priced it at $24.31. The market's pricing it at $15.75. It means that the volatility that the market is using is far less than what we assumed at 30%. Okay, so it says what are the sources of the error. The Black-Scholes assumptions are incorrect, and the sigma could be incorrect, which is kind of related to the Black-Scholes assumptions. What I mean the Black-Scholes assumptions, for example, the returns might not be normally distributed. If they aren't, then the Black-Scholes model could fail for that reason. And it could also fail because it might be the correct model assumptions, but the input that we're using, the sigma, is wrong. So those are two popular reasons why the Black-Scholes fail. Yes?
Would you necessarily assume the same sigma for different term calls?
No.
Because it seems to me short-term would be more volatile than long-term. Long-term.
Not necessarily.
I would have thought, well, for something like IBM, I would have thought long-term it would have approximated its historical pattern.
No, that could be true. And if the short-term volatility is higher than the historical approximation, then correct.
But in general, you would use different sigmas for.
Well, let's actually address the question in a different way. What is the market saying the sigma is? Okay, we know it's saying it's less than 0.3. Well, let's do that. Okay, and that's the idea of implied volatility. So let's do some implied volatilities. And let me show you how to do that. Remember I said that there was no easy way to do this? That there's no formula for implied volatility? And I said that if you're coding this up in Excel, you'd have to use solver to do it. Now I think I also said it was very similar to that question on assignment number 1, where you had to get the present value, you knew the present value was 94,000, but you didn't know what the interest rate was to get the present value to equal 94,000. So you had to try different interest rates to get 94. Okay, we're going to do the same sort of thing, where we're going to try different sigmas to get the Black-Scholes to deliver the market price. So we observe the market price, or we observe $94,000. We try different sigmas to get the Black-Scholes value exactly equal to the market price. And that sigma that we do that finally hits the market price is called implied standard deviation. So let's do that. So the steps are to calculate the actual ratio of the call price to the ex-dividend stock price. So the actual call price, 1212 divided by 263.24. That equals 0.046. Okay. And then what we're going to do is we're going to go to the Black-Scholes tables, and we're going to look down the column of 1.024 and search for the cell that's 0.046. Okay, so let me put that up. So what we're going to do is to look down this 1.02. We're going to search for the cell, which is 0.046. And then we're going to read the row up. And the row tells us sigma root t. So contrast this with what we did before, where you're given the sigma. Then we go down this column, we go across the row, and read off the cell. Now, basically, I'm giving you the cell. So we go down the column, find the cell, and read the row. There's three things, basically. I'm giving you two, and you figure out the last one. So that's what I'm going to do. Go down 1.02, and this is 1.024, so it's a little to the right of that. Search for 0.046. Go down here, and it's going to be somewhere around here. And there's no dot there. Too bad. And I'm going to read the row up. It's a little below 0.09. Is that correct? Did I get this right?
Yeah.
1.02, I'm searching for 0.046. So if I'm down here, I'm in the wrong area. It's going to be one above. So 1.02, and so it's in this area, 0.042, 0.046. So 0.08, a little below that. Let's say I should go actually do it in the notes as 0.083. Okay? So sigma root t is 0.083. And get rid of the root t by dividing both sides by root t, and I get 20.2%. Okay. This is an implied volatility. So this is the volatility. The 20.02% is the volatility that when we use it in the Black-Scholes formula, it exactly delivers the market price of the call. Exactly delivers it. So, as I say, it's a matter of plugging through and doing a number of these so you get the knack of it. It's actually not that bad to do once you get used to it. That's the 2-month. Notice the volatility is much lower than what we were using originally, 0.3. It's saying, the market's saying 0.2, we're saying 0.3. The other thing that we could do is the same exercise for the 5-month. Take the ratio of the call price to the ex-dividend stock price as 0.06 and go down that column of 1.03 and search for the cell 0.06. Okay, let's do that. So it's 1.03 and a bit. And search for 0.06. So here's 0.059. We're a little to the right. So it's about 0.06. Read off the row, and let's say it's 0.11. So it says that the sigma square root of t is 0.11. And then we can divide by root t, and we get a sigma of 17.1%. This is an annualized standard deviation over 5 months. Yes?
And that's the forecasted sigma?
This is the sigma that the market is forecasting for the return of this particular stock.
So if I have a model and I think that my sigma, for some reason I have insight on it and I calculate it, I could go through and I might think if my sigma is greater than the market's, I would go ahead, on certain stocks, I'd go ahead and buy the option because I think the option price is more likely to come into play than the market.
Sure. So when people trade options, they're basically trading their forecast of volatility. So when they talk about the price of the call option, sometimes they won't even talk about the price of the option. They'll talk about it, well, it's trading at 17% volatility. Okay, and I think that's cheap, right? Because I think the volatility should be 20. And we haven't seen the 17% in, like 10 years. So you're buying the volatility, you're selling volatility. Everything is in terms of volatility. Yes?
If you were truly doing trading on volatility, wouldn't you want to take a spread position?
Yes.
Because you're in addition to the volatility going up, you're
Right.
also.
So let's say you think it's cheap, 17 is cheap. If you just bought the call option, okay, this is real important. You just bought the call option, and then the next day, volatility magically increased to 20%. That would seem to be a good thing for you, because you know that if volatility goes up, the call also goes up, right? But what happens if the stock price drops by $5? What happens to the value of call there? Plummet. So even though the volatility might go up the next day, if you're just naked in that situation of just holding the call option, you could lose everything. So we always want to be smart about that and set up a hedge. And I'll show you how to do that. But notice that the 5-month had an implied volatility of 17. The 2-month had an implied volatility of 20. That's different. Is there any reason that they should be the same? Not that I can think of. Because people have forecasts that not necessarily the same, just like interest rates have no reason to be the same for 2 months and 5 months or 5 years. People have expectations over different horizons. So it doesn't have to be the same. Yes.
Wouldn't you expect the longer term to have a higher volatility? Or is that term already factored in?
Yeah, because the volatility, like the total volatility is sigma root t. And yes, if root t goes up, then the total volatility goes up. But on an annualized basis, not necessarily. Okay, so that's implied volatility. And then there's 2 last things that we need to know, which are kind of straightforward extensions of this. And the first one is called delta. The second one is called elasticity. Yes.
Use of continuous dividend payout. I mean, what if you anticipate the dividends will go up?
You know what the dividend is going to be, okay, in let's say 2 months. Then just take the present value of the dividend, knock it out of the stock price. Okay, and I give you the 2-month interest rate. Just do it like you usually do it. Okay. If I give you a dividend yield, like 4%, then you can do it this way. Or you can do it the other way, I don't care. This way it just seems to be pretty quick. Yes?
How come when you calculate the present value of the exercise price, you do it the negative part? Like, then you're assuming it's continuous as well. Like, you know, I don't see why you just don't discount it back using the charity.
It turns out that I might give you, if you looked at the midterm exam from, I'm not sure what last time's midterm did. I either give you a rate or I give you a bond price.
Okay.
If I give you the bond price, then just multiply that times the exercise price.
Okay.
If I give you the interest rate, then use the e to the negative RT or use whatever formula you're comfortable with. It's not going to have a real impact on the value of the option. So if you use e to the negative RT or 1 divided by 1 plus r to the power of t, fine. Okay? Whatever you're comfortable with. It just so happens to be consistent with this lecture note, given that Black-Scholes is in continuous time, that I use continuous notation. Like in any other textbook also in derivatives does this. Okay, delta. Okay, the delta, these are two, I think, real intuitive measures. The delta tells me for a $1 move in the stock price, what is the dollar move in the option price? Okay. For a $1 move in the stock price, what is the dollar move in the option price? And it turns out that we can use the identical tables to do this, except it's called Table 2. Table 1 is the call value as a percentage of the current stock price, ex dividend. And Table 2 is the delta. And let me pull that out. Call option delta. When you do the same thing, you go down the column, across the row, and you read off the delta. So we went down the column 1.02 and across the row, I forget what the row was for the 2-month option. Help me out.
0.123.
0.123. Okay, so 1.02, 0.123, right there, and 0.02, so we're in this cell right here. Interpolate, and I say approximately 0.6. So what does that mean? It means that if the stock price goes up by $1, the predicted dollar change in the option is going to be 60 cents. It's going to go up by 60 cents. And we can also do it for the 5-month call, and it turns out to be pretty close to the 2-month delta. It's 0.61. There's another interpretation of the delta. The delta tells us the so-called hedge ratio. Okay? So the delta tells me how many shares I need to purchase to hedge the sale of one call. Okay. Let me try to explain that. Remember, Harvey?
Say it again.
Well, we'll say it again. I'll say it maybe 3 times. The delta tells me how many shares I need to purchase to hedge the sale of one call. It's telling me the coverage that's required for a hedge. Now, suppose that I go through this exercise, okay, and I calculate the implied volatility of the option is 0.2. And then I look at the implied volatility of the 3-month option, the 4-month option, the 5-month option, and even the 1-month option. And all of those implied volatilities are like 0.17. Everything except for the 2-month. Very suspicious. Okay, and I've got my volatility forecasting model going in the background, and it says the 2-month should be 0.17. But it's trading at 0.2. So this is an opportunity for me, and what am I going to do? What do I want to do with the 2-month option? Sell it. It's overpriced, according to my model. Okay. Now, we run into the same danger if we just did that. If we just did that, we run into the same danger as if we were just buying the option. That the volatility could adjust to our forecast exactly. But if the stock price moves, we could be in real trouble. So this is a sale of an option. And it might be that the next day it goes from 0.2 to 0.17, which is exactly what we want. But it could also be that the stock price goes up. It's bad news for us, because we're selling the option. So we need to cover, and the way that we do it is that we buy delta shares. Yes?
Which delta? The one we
Delta-
think or the other one?
Pardon me?
The one we think or
What
the
we
market?
think, important. Okay, we use the volatility that we believe in. So let me go through this in my head. Then let's say we sell that option at 0.2. The next day, it goes to 0.17. Everything else remaining equal, and let's say the stock price didn't move or anything, then the value of the option goes down, as it should, and we reverse out and make a profit. The other possibility is that the volatility adjusts to 0.2, or from 0.2 to 0.17, and the stock price goes up by $1. Suppose the delta is 0.6. What's going to happen to the option value? It's going to go up by 0.6 or 60 cents. If I'm writing the option, I lose 60 cents. Right? So when the price goes up, that's bad news. So how do we get around that? Well, we buy 0.6 of a share. We're not going to buy 0.6, we're buying 600 shares or something. So if we have 0.6 of a share and the price goes up by $1, how much profit do we make? Price goes up $1, I've got 0.6 of a share. 60 cents. So this exactly offsets the loss that I took on the option that had to do with the stock price movement. And the profit that I get is based upon the volatility. So this, I'm hedging against movements in the stock price that don't have anything to do with volatility. So the delta is the hedge ratio. That's why it's called the hedge ratio. Okay, let's do another example. The opposite side. Now suppose that the option is underpriced. Okay. So suppose that the option is trading, the implied volatility that we get is 0.1 for the 2-month option. Everybody else is 0.17. So it's way out of line. And our model says 0.17 is the volatility it should be for 2 months. So what are we going to do for the 2-month option that's trading at 0.1 volatility? Buy it. So if we just buy it, put it into our portfolio, let's say our portfolio is a pretty small portfolio, I've just got the option in there. And the next day, the volatility jumps up to 0.17. Everything else remaining equal, that's good news. Because we know the value of the option is going to go up, I'm going to take a profit. But the odds are something else is going to happen. The odds are the stock price is going to move. And what if the price goes down? So the stock price could go down, even though our volatility forecast was 100% accurate. The price of the option is going to plummet, and we could take a loss. So we want to hedge against that scenario of the stock price going down and us taking a loss on the option that's due to the stock price and not due to our volatility forecast. So what do? How do we hedge that? Short the stock, how many shares? 0.6 still. Work it out, it actually works, and this is how it's done. Okay. Now this is called like volatility arbitrage. And let me put quotations around the word arbitrage, because this is not arbitrage in the sense of the put call parity arbitrage. Put call parity arbitrage is pure arbitrage. It is arbitrage where you make a profit with no possibility of a loss. Even if we go to all this work to set up the delta hedge, it's possible we could still lose money on this transaction. And the reason is that our volatility forecast could be just plain wrong. Okay? So there's an element of risk to this that's based upon how accurate our volatility forecast is. So that's the delta, and the elasticity is just a related measure to the delta. It just measures the percentage change in the call price divided by the percentage change in the stock price. So it answers the question for a 1% change in the stock price, what is the percentage change in the option price? And that's the table 3. And let me just flash table 3 up. And again, we could look at the same sort of cell 1.02, the same sort of row 0.123, and the elasticity is around I think 10. So it says for a 1% move in the stock up, the option is going to go up by 10%, 10 to 1. This should emphasize to you that options are very volatile instruments. Okay? The option that we chose is a pretty regular option. The exercise price is fairly close to the current stock price. Not too long to go, but it's a 10 to 1 movement in terms of percentage returns. 10 to 1. And you can also see up here some very large numbers. They're more like 100 to 1. So for a 1% move in the stock, you might get a 100% move in the option. Let me emphasize that these are also only approximations to what's going to happen. And every day, these approximations are going to change. Okay, so every day we have to go and recalculate the present value of the exercise price, and there's a new stock price, and you have to continuously update this. So that's the elasticity. So those measures use the same methodology as I said. Go down the column, across the row, read the cell. All 3 tables are identical. Okay. Now let me just give you a bit of this might sound silly, but be careful you're using the right table. They're labeled real clearly as to what they are. One year I mixed up the tables. I don't think I mixed them up. The copy center mixed them up so that table 2 came first, then table 1, then table 3. And we were going to table 2 to figure out the call option price. And you probably notice that table 2, the numbers are much larger than in table 1. So table 1 was like 0.061 that we're looking at for the call as percentage of the ex-dividend stock price. Table 2 was like 0.61. So just be careful. I'm not going to do that, obviously, if I can avoid it. But be careful you're looking at the right table. It's 3 different measures. The last thing is for put options. And the formula, I'll show you where the formula comes from. But the formula for the delta of the put option is the delta of the call option minus 1. So if the delta of the call option is 0.6, the delta of the put option is negative 0.4. It's always negative, which makes sense, hopefully. If the stock price goes up by $1, the put must go down by a certain dollar amount. So it's delta put equals delta call minus 1. And the formula for the omega of the put, and I don't know why it says PC there. I think that C is supposed to be expunged. So that should be omega just P. The omega of the put, or the elasticity, is the delta of the put multiplied by the stock price divided by the put price. Okay, so that's this is basically all that you need to know for this course in terms of options. Okay, now the next thing, I've given you kind of the framework. We've gone through a few examples. what I want to do is to take our break now and come back and go through the midterm exam, which is a couple more applied examples in options. Okay, and I said this twice already, but I'll say it again. I'll say it when we get back from the break. The way to study for this exam is to do examples. And these examples are remarkably easy to construct. In a way, it's remarkably easy for me to set the exam. Okay? So the more that you do, the better that you get at it, the faster that you get at it, and the better you're going to do on the midterm exam. Okay, so let's take a break, a 10-minute break, and that will give us an hour to go through the previous year's midterm.
When is this? When is this?
Okay, let's start on this midterm exam. First question is on forward interest rates. Given the price of a 1-year zero, price yield 4%, 50-year is 5%, 3-year is 6%. And I say stated rate annual compounding to make it easy. Oh, so if I given the wrong midterm up, is this it? Or is this year? Can't tell. Same question. Do you have that? Does this match? Tell me, does this match what I gave you as a Okay, so we got 3 zero coupon bonds. And then the question is, we're for a pension fund responsible for investing $100 million for 2 years, but you will not get the cash until next year. It's very similar to the question that we did in class, except it's a 2-year investment. However, you will execute the transaction today to lock in the future 2-year return. Okay? Assume the par value of the bond is $100. Describe the transactions today, next year, at the end of 3 years. Ignore transaction costs. What's the rate of return annualized that you lock in between years 1 and 3? That's question A. So the first thing that we do is to calculate the prices of the zero coupon bonds. That's going to be 1 divided by 1.04. 96.1538. I carry 4 decimals of precision. And Z2 1.05 squared. 0.9029. And Z3 equals 1.6 cubed. That equals 83.9619. All in terms of $100. So we're going to start with that. And then we're going to do basically the same story that we did in class. That we're going to sell the 1-year bond. We're going to take the proceeds and invest in the 3-year bond. So we're going to sell 96.15380 of 1 year. Okay, invest in as much as possible. I'm using words here that you need not use. Your answers don't need to be in sentences, just the main form. Okay, terse is preferred. So how many can we buy? Well, it's 96, 153,800. Price of the 3-year is 83, 83,9619, and that equals 1,145,207 of the 3-year bonds. Okay, and next year. So this is today. Next year, you get the 100 million cash flow, right? Your pension fund, 100 million comes in. You pay off or retire the 1-year bond, or if you want to think of this in terms of your debt, and then basically we've got in our portfolio this 1.145 million of the 3-year bond, which has now got 2 years to go. We hold it to maturity. In a maturity, it's worth 1,145,207 times $100, because that's what the bond is worth at maturity. That equals 114,520,700. So our rate of return over 2 years is 114,520,700 minus 100, which is what we invested at the end of year 1. And again, you need not even do this calculation, like I'm writing it out, but it should be obvious. You should be able to do a percentage return based on 100. So this is really wasting time in an exam, what I'm doing right now. And that is a 14.52% return over 2 years. And I guess we could say that, and I forget how I graded this, but if you just took that and divided by 2 as an annual return, I think I said that was okay, but probably better to go 1.1452 to the half minus 1. And I think that equals 7.014%. So that's the annualized return that we're locking in. And so that's 10 points. That's 10% of the exam. Gone. 10, 15 minutes. So how long did that take? Okay, B part says, what is the forward rate between 1 and 2, between 2 and 3, and between 1 and 3? Okay. And take to at least 4 decimal spots. Okay. Well, it's just a matter of the formula for the forward rate is 1F2 equals 1 plus 0R2 divided by 1 plus 0R1, and this one is squared. We subtract 1. And the formula for the 2 to 3 is 1 plus 0R3 cubed, 1 plus 0R2 squared, minus 1. And the formula for 1F3 is 1 plus 0R cubed divided by 1 plus 0R1 minus 1. You should be able to work that out. This, I think, pretty easy. Because you're given all the interest rates. It's just a matter of manipulating that formula. Everything's annual. If we want to annualize this one, because this is a 2-year rate, we basically take the square root. And lo and behold, when we do that, we're going to get, this is going to equal 14.52%. And the annualized is 7.014%. Exactly what we calculated before.
And subtract 1? Take the square root, subtract 1?
Yes. Yes. 1 plus the rate square root, subtract 1. Exactly what we got on our other calculation. And the final part of the question says, is there a relation between 1F3, 1F2, and 2F3 be precise? And it turns out that there's many different ways that we could establish this, but it turns out that we could also write 1 plus 1F2 to the 1 plus 1 plus 2F3 to the 1 equals 1 plus 1F3 squared. And in my bulletin board posting on that Eurodollar question, it kind of suggests the solution for this. That with the forward rates, we can always put these in terms of the zero coupon bond rates. So if you don't believe this equation, just substitute the known formula for 1F2 for 2F3 for 1F3, and it's going to hold exactly. So this is a very general sort of setup. Yes?
I'm still confused on the last overhead slide. Can you put that up real quick for a question I have with your formula?
Yeah, maybe I got it wrong.
No, I'm sure you have it right. I'm just confused. in that bottom formula where you have the 1F3,
Yes.
I thought normally your forward equation is like in parentheses 1 plus that 1F3 squared equals 1 plus 0R3 cubed over 1 plus 0R. Like, where did the square root? I don't understand how you got rid of the square root so fast.
Yeah. Well, you're exactly correct, and I guess what I've done is made an error. So I was correct in saying that I made an error. Yeah. So let's write that out more precisely. So when in doubt, go to the original formula. It's 1 plus 0R3 cubed equals 1 plus 0R1 to the power of 1 times 1 plus 1F3 to the power of 2.
Right.
Right? So, and then solve for 1F3. So it's 1 plus 1F3 equals 1 plus 0R3 cubed divided by 1 plus 0R1. And this has got a square on it. Got to get rid of the square. You're right. 1 plus 1F3 equals the square root of this whole thing. So I would have lost some grades on my own exam. And you would have scored higher than the guy that wrote the exam.
Can you keep that in mind when I'm
Okay, that's good. Okay, so that's question number 1. Let's go to question number 2. Current rate is 9% compounded annually. You have a choice of investing in 2 20-year bonds, a 9% coupon bond, annual coupon, and a 2-step coupon bond, 8% for the first 10 years and 10% for the next 10 years. The par value of both bonds is 100. And it says to price the 2-step bond, which bond has the highest modified duration, no calculations necessary. And suppose you bought the 9% bond and financed the purchase with the sale of a 2-step bond. How would you go about hedging your interest rate risk with futures? Well, futures is not going to be on the exam, so I'd probably change that to options. Okay? No calculations necessary. Well, that helps a lot too. So, the main thing here is the current rate of interest is 9%, and we've got a 9% coupon bond, 20 years to go. What is the price of that bond? We have to go through the annuity formula and everything. This is par, right? Right. So we don't have to do anything. The key to this question is to get the 2-step bond. Part A, price the 2-step bond. 2-step bond's got a lower coupon in the first part and a higher coupon later on. So the way that I like to do this question is to draw kind of a timeline. That for the first 10 periods, we've got 8% coupons, and then we've got 10% coupons after that. So beginning with 10, so we go 0 to 10, and we also get our principal here of 100. Here's 20. Okay? So this is the way to do this question. You do it in pieces. The first piece is to price 10 8% coupons, given a rate of 9%. Okay, so just calculate the annuity for an $8 cash flow for 10 years. Okay. And so we need the annuity factor, given 9% rates, which is the true rate the economy is given. And for 10 years. And we can do that, and the formula is, what is it, z times 1 minus z to the power of 10 divided by 1 minus z. And that annuity factor equals 6.417 plus some other stuff. Yes?
How come sometimes you have when you have your general formula z times 1 minus z to the n, how come you have an a in front of z sometimes and other times you don't? When do you know that a equals 1?
Well, the general annuity factor is, when I say annuity factor, means the value of $1 each period. So the little a is always there, except this is 1.
So in this case it's 1, okay.
And now I'm going to put the little a in there because the little a is not 1, it's 8.
Okay.
So multiply 8 times this, so 8 times the annuity factor, and that equals 5134. Okay, the next thing that I'm going to do, so I've priced like A part. B part is I'm going to price a 10% coupon bond that's got 10 years to go, but I'm going to price it like I'm standing in year 10. Okay? So just use the standard formula. So this is going to be B part. So B part is, this is A, this is B. So price a 10% coupon bond, 10 years to go. And what is that? That's going to be the same annuity factor, right? Times a different coupon. So it's going to be 10 times the annuity factor, which is going to be 64,176. But don't forget the principal, because we have $100 at the end, right? Right here, we've got $100. So we're going to take 100 and discount that back to the time, 10 years. So 1.09, 10. And that part equals 42,241.
Why would you discount for 20?
Because I'm doing this exercise to price the 10% coupon bond in year 10.
You're eventually going to discount that back.
You bet.
Also, so good point.
Right. Just to make it simple, I'm pricing a bond in year 10, and that's going to equal 106,417. Now, let me tell you the mistake that a lot of people made at Chicago when they did this question. They said, okay, well, we got 5134, and we got 106,417. Add them together, and you get, what is it, $157. It's the price of this bond. Which kind of flies in the face of your intuition as to what the price should be. Because look, the 9% coupon bond is trading at 100. Then we're just changing things a little bit by dropping the coupon in the first 10 years, but then increasing it in the second 10 years. You're going to tell me this bond's worth $150? So the mistake is not realizing that you price this bond in year 10. We have to bring it back to time 0. So we can do it by pieces, like you're suggesting. So I could just take the $100 at the end, put it back 20 periods, or we could just bring the whole bond back. So take the 106, then divide that by 1.09 to the power of 10. And that equals 44.95. And then add A plus B, and that equals 96.29. Yes?
For the first part, sometimes you also have a C. Is the C and A the same thing?
Yes, and this example with coupon is just the little a.
Because in the general formula, you have like C times A.
Yes, exactly. The notation is not as important as understanding how to use it. Okay, and yeah, the coupon is the annuity in this example.
We have a financial calculator. We use that to calculate the present value.
You know, certainly you could, but you could certainly make a mistake in doing the two-step bond. Okay, your calculator, well, the danger of doing it just with a calculator, I need to see the logic of what I'm doing. Because if you just put down the number and it's wrong, you know, I can't give you anything, zero. Like, I don't like giving zero. Like, I'm pretty good at giving partial credit, right? But I need for you to give me something. Like, if you're running out of time, right? And which hopefully you won't. And you just tell me, well, this is how I'm going to do it without putting the numbers through it, then I'll be very generous. Okay, it's more important for me to understand that you know how to set this up than to actually get the number correct or actually do the calculation. So that's why I'm saying I prefer if you actually did this writing it out. And I find people that use the financial calculators for some of the questions tend to get some zeros.
Would the diagram there show a logic of thinking?
Well, not completely, because we want to make it clear, maybe some extra arrows, like discount this back from year 10. But the diagram's helpful. Does it make sense that this bond is worth less than 100? Why? Yes?
Because for the 9%, you've got 9% the whole time, which should be 100. And here you're delaying, you've got less sooner and more later.
Less sooner and more later.
Less interest
No.
sooner and more
I
interest later.
understand.
Yeah.
What you're saying is precise. Less sooner and more later. No, I really mean it.
And they're equal on both sides as far as the amount lower.
So, what does that say about the concept of duration? You can get less sooner and more later. Higher duration. So, almost immediately we know it's going to have a higher duration, just by what you said. Another question? Okay, so I think that answers everything, right? Which bond has the highest modified duration? Why? Well, just what you said, less sooner, more later. That's enough. Okay? I don't need the formula. I don't need the derivative. Just tell me less sooner, more later. Suppose you bought the 9% bond and financed it with the purchase of the two-step bond. Well, it turns out the two-step bond has a higher modified duration. Okay? So it's going to be more sensitive. So you bought the 9% and financed it, so you're selling the two-step bond. And when you're selling, is it good for rates to go down or rates to go up? Often it's best to think of it when you're buying and then just as a reverse. So when you're buying, is it good news for rates to go down or rates to go up? Yeah. So when you're selling, the good news is when rates go up. Okay. So when rates go up, that's good news. When rates go down, for us, it's bad news. When rates go down, price goes up. What sort of option pays off when prices go up? Call option. So we definitely want to take some sort of call option. And you don't have to work out the details of it. There's some explanation that's worth far more than 3 points there. But you just have to figure out what your interest rate exposure is. What's good news, what's bad news. Okay, well that's that. And 3 is bond valuation and hedging, and long question. There's a lot of talk in this question rather than, so Treasury is going to issue a huge amount of debt. They're seeking ways to save money. You have an idea. They could issue floating rate bonds. So these bonds, basically the coupons pay 7 annually, but the rate adjusts, and assuming that it adjusts like instantaneously to changes in the interest rates. Okay, and the 3-month Treasury bill is the rate that everybody believes is the true rate. And question A says, what do you think the market price of the floating rate bond should be if the face value of the bond is $100? And the idea here is that in the special case that the coupon exactly equals the interest rate, we already know that the bond's going to trade at 100. Well, by making the coupon change with the interest rate, we're forcing the coupon always to equal the interest rate. So this bond is going to trade around 100. It's going to be real close to 100. It might be a little off because there could be a delay in resetting the coupon. But basically, part A, what do you think the price of this bond should be? It's $100. No formula is necessary. And that was kind of a hint.
We just write it down, or we say $100 for the
$100. You might also want to add what I said here, coupon exactly equals the fair rate to the market price is 100. And that just double emphasizes that you know what's going on. B says, what is the elasticity of this bond? That is, what is the percentage sensitivity of the bond to change in the fair interest rate? Okay, and then again, a hint, no duration table necessary. And remarkably enough, I had one student do the duration table, which instead of a table was 60 rows. Yeah, so remarkable. So no duration table necessary. So what if the rates go up, and I've got an example here, if the rates go up from 3% to 4%, what's going to happen to this bond? Well, the coupon gets reset. The bond is always going to be priced in around 100. So it doesn't matter what happens to the rates. The elasticity is real close to 0. And that's all I was looking for in B for 5 points. C, you're a portfolio manager, you buy the 30-year fixed rate bond, i.e. 7% coupon bond, and suppose the modified duration is 10. And you hedge it with options. What kind of options do you buy or sell? 4 possibilities: buy call, buy put, sell call, sell put. We've got a 30-year fixed rate bond. If interest rates go up, what happens to the bond price? Damn. Is that good news for us?
No.
Bad news. To establish the bad news scenario, interest rates going up, bond prices going down. Hedge by providing an offsetting cash flow. Okay. So we need something to pay off when the price goes down. What kind of option is that? Put. Do we buy or sell? Buy. Almost always buy. You tell me sell call option means. I don't want to see that. Buy for hedge.
No.
It's not going to provide the same type of hedge to do the payoff. So almost always when we hedge, we're buying options. Okay, D, assume the delta of the call options is 1. So it's moving 1 for 1 with the underlying bond. Simplifying assumption. And the delta of the put options is -1. That's obvious by the formula. How many contracts do you need to hedge a $100,000 portfolio of the bond in C? The option contract is for a $100,000 bond. Assume the market value equals par. The modified duration of the bond in the options contract is 6. So we're going to go and figure out the loss for a 1% move in interest rates. Okay, so a loss in our portfolio for a 1% move. Okay. And that's a dollar loss. And that's going to equal A times the gain. Is A a bad, maybe B, because little a was the annuity formula. I don't want to confuse you. Times the gain on option if rates up 1%. That's the formula to establish how many contracts we need. So it's a dollar, and we're solving for the number of contracts. So we know that the modified duration of what we're holding is 0.1 for 10%. So what is the loss for a 1% move? Rates go up by 1%, modified duration is 10. 10%. We have a $100,000 portfolio. How much do we lose? $10 million. So it's 10 million equals B times the gain on the option contract if rates go up by 1%. What kind of option contract do we want? Okay. And what is the gain going to be on a $100,000 contract if rates go up by 1%? Elasticity is 6%. So the gain is going to be $6,000? Is that correct? It's $100,000. 6,000? Solve for the B. And if you get an odd contract size, just round to the nearest one. That tells you how to set up a hedge. Very useful information. So all we're doing is recognizing that the modified durations are different. E part, suppose the delta of the call is 0.5, the delta of the put is negative 0.5. Does this affect the size of your option position? Definitely. So it decreases the sensitivity of the option to a move in the underlying bond price. It's effectively knocking the duration down from 6 to 3. So when I calculate the dollar move for a 1% gain on the options now, it's going to be $3,000. So what you need to do is to double the number of contracts to get the durations matched. And what is that? Calculate the return on to calculate the return on the 30-year fixed rate bond, one must also consider the cost of hedging. Okay. Does this increase or decrease the return? Hint, remember the mortgage problem on assignment number 1. Can you reconcile why people would be willing to pay $100 for a floating rate bond, which would have the first coupon of only 3%, and $100 for a fixed rate bond, which today would have a fixed coupon of 7%? Okay, and let me just talk the answer to you. There's mortgages, there's a floating rate mortgage, or an adjustable rate mortgage, and a fixed rate mortgage. And often the adjustable rate is way below the fixed rate. So why would you pay the extra amount for the fixed rate mortgage? Rates could go above. And if rates go above with the fixed rate mortgage, you've got just the fixed rate. If rates go down with the fixed rate mortgage, what do you do? So the difference, has to do with that, with the option, and with the. This is the same thing with a floating rate bond and a fixed rate bond. Very similar idea. Yes.
I'm sorry, I'm kind of missed why you double it in E. How do you know to double?
Oh, with the back in point E?
Yes.
So you calculate for a 1% move, what is the gain on the option? Okay, so we know that for a 1% move in rates, the actual bond price is going to go up by $6,000, right? Or down by $6,000, right? The underlying bond. Before I said the option moved 1-to-1 with the bond. The delta was -1. So if the bond goes down by $6,000, my put option should go up by $6,000.
Right.
But now I'm changing the question. I'm saying the delta is 0.5. That means that for a $1 move in the bond, the option is only going to go by 50 cents. So the total gain on the option is not $6,000. It's going to be $3,000. So that's where the delta comes in. Yes?
Going back, question to D, I'm confused where you got the delta from, because I thought the formula is delta put equals delta call minus 1. And if your delta call is 1, your 1 minus 1, your delta P should be 0, isn't it?
Absolutely. And that assumes that the strike price is identical.
And from what my assumption was, that formula?
Yeah, the formula
Okay.
is for the exact same strike prices, and I'm just saying the put option that you're going to choose is a different strike price than the
Okay.
call. That's why I literally gave
Okay.
the two extremes. Yes?
For the last one, with the analogy with the mortgage, if I'm understanding correctly, that holds true except in the opposite expectations I would have. I mean, if I have a real mortgage, like on a house or something, and interest rates go up and I'm locked in, I'm happy, but I would not be happy with the bond.
Yeah, it's not. Yeah, it's not exactly the same thing because there's you've got the option. It's like a convertible bond or a callable bond. It's not exactly the same. But kind of the intuition of the question is that you've got to put in like some hedging costs because the other side is always going to be hedging. So the bank with fixed rate mortgage got to do a hedge, or it's really exposed to interest rate changes. Okay, well we're doing fairly well, I think. And let's go to question number. Actually, it doesn't look like I've got question number 4. Question number 4, find the following information. Intel, July 105. There's the call price, the day's expiration, the bill price. Dividend yield is 0 to make it easy in the stock price. So it says, find the implied standard deviation. Okay, well, let's do that. So first establish the column that we're going to look down. The first thing is S divided by K e to the negative RT. And it turns out we don't even have to work that out because I've given you the bill price. So it's going to be 105 times 0.9966 right here. And that equals 1.021. Step 2, the call divided by the stock price. And that turns out to be 0.061. So we're going to look down the column, and we're going to search for the cell 0.061, and we're going to read off the row. So we're going to read the row is number 3 step. And when you do that, I actually calculated it, the row to be 0.125. I'll tell you what T is. T is 42. So that's going to be put, well, the days are 42. So T is going to be 42 divided by 365. Solve for sigma. And I think it's 0.368. That's the implied volatility. Actually, for 5 points, I also asked for the delta and omega. It's asking a lot, I guess. But the same steps, except now I'm looking across this row. The delta of the call is 0.588, and the omega of the call equals 9.8%. And you can verify these by using the tables. And then in words, it says, what's the definition of the delta? Well, we talked about that today. The delta tells us for a dollar move in the underlying asset, what's the dollar move in the option? And it also, I would say, give the hedging interpretation. It tells us how many shares we need to buy to hedge the sale of one call. Exactly what we said when we were talking about that. So that's easy, 3 points, I think, because that's probably right on your cheat sheet, right? C part, suppose that your volatility forecast says the volatility should be 45%. Set up a trading strategy to capitalize upon that. Sure.
Would you take them as the right most of the time so we don't have to calculate so much?
Well, I can't tell you exactly what I'm going to do, but given there's a lot of serial correlation, it's a high probability something like that will be there. Okay. C. Suppose that you've got the volatility of 45%. We've already established the implied volatility is 36.8%. What is that going to imply about the Black-Scholes price based on our 45% volatility? Higher. So the current price is 650. It better be higher at 45% volatility. So what are we going to do for C part? We're going to go down the row, 1 point, or down the column, and then we need to establish our sigma root t, which is 0.45 times 42 divided by 365, which equals 0.153. And that's going to be the row we're going to look across. We're going to pick out a cell, and the cell is going to be C divided by S, and that I interpolated to be 0.071. And then the call is going to be 0.071 times 106,875 equals 7, I think I wrote 759. Approximately. You're not going to exactly get this number, that's fine. And notice the price is higher than the price that we see the option trading at. It's trading at 650. So if we're going to do something with this, are we going to buy this option or sell it? Buy it. Let's do that. So let's buy the option. Because it's cheap. It's cheap. But we're not just going to buy the option. We're going to do what I said about hedging. Okay. And if we buy the option to hedge, we're going to sell delta shares. And the delta should be calculated based upon our forecast of volatility, not the volatility that we think is incorrect in the market. So we need to calculate another delta. So calculate the delta C, and this is, I think, important. The delta C based upon our 45% volatility, and it turns out to be 0.582. And then I actually ask you to do a little table, like we kind of did for put call parity. So we've got an action, cash in, cash out. We're going to buy the call, and that's cash out of 650. Right? We're going to sell delta shares, And that's going to be 0.582 times the share price, which is 106,875. And that's going to be 62.20. And we got some leftover money. What do we do with it? We don't put it in a mattress, we invest it. Okay, risk-free. So we invest 55.70 in treasury bills. And the cash in is 62.20. The cash out is 62.20. And that's how to set this thing up. Yes.
I'm sorry, I'm slow. I don't understand where you got that 0.582 from. The change in state, is that from a table or is that a numerical?
That's the delta table.
Oh,
Yes.
that's just the delta
So
table.
what I did is, based upon my new volatility, 45%, to get this number, let's put a star here. I go down the column of 1.021, across the row of 0.45 times 42 divided by 365 equals 0.153. And when I read the cell, it says 0.58 in around there. So this is using table 2.
Okay, thank you.
Okay? Yes?
Could you just go over again the relationship between the implied volatility and the 45% volatility that you have up there by the star? I mean, what's the...
The implied volatility is the volatility that makes the market price of the option exactly equal to Black-Scholes price.
Okay.
Okay? The 45% is another volatility. It's my forecast.
Based upon...
I think I'm better than the market.
So this is just a number you can pull out of... Okay, so based
It
upon...
might not be just pulled out. It might be explicitly like forecasted. So.
Okay. So if your volatility is greater than the implied volatility, then what's the course of action for that?
If my volatility is greater than the implied volatility, and I believe that the volatility in the market is going to adjust to my volatility, that means I think the prices of the options are going to go up. So that means I want to buy and make sure I hedge. Just think of it as volatility as kind of a price. You think the price is higher than the price in the market, so you want to buy. Getting there.
Can you just do that last line again? It's if your volatility is greater than what the market says the volatility is, you're going to buy and hedge?
Yeah, because you think the option's worth more than it's trading for. You think it's cheap. Yes.
Where do you determine the sell
That just equals delta, the delta times the stock price. The delta tells you the number of shares, and the stock price is going to tell you the cost of actually doing it. And we'll look at the other thing. Let me warn you that there's 2 questions on options, and that's one of them. The next one kind of looks the same, but you just kind of like scan the table. And I even say this, I said the only difference here is the inclusion of the put price. So in question number 4, a mistake that was made by the Chicago students is they tried to use put-call parity for that question. But had a lot of trouble because there's no put. So some of them invented a put price. So assume the put price is, there's no way that you can make an assumption like that. Okay? Or some of them even looked ahead to question number 5 and notice there's a put there, so then use that. But don't use information in another question for the previous question. It's not generally a good strategy. If there's a call and a put, then the odds are that it's going to be put-call parity, right? If there is just a single option price, and I'm giving you like volatility and stuff like that, that means it's a Black-Scholes question. Okay, so one thing you got to recognize quickly is what framework we're going to use. And in question number 5, it's a 14-point question, and it is basically a put-call parity question. And we've done almost all the calculations already, so we know what the call is worth, we know what the put is worth now, we know the stock price, we know the present value of the exercise price from the previous question is 0.9966. Plug into the put-call parity formula, C equals P plus S minus PVK. We know C is 650, and this stuff equals 6482. And I say for 4 points that we're close enough. Okay. We're off by 2 cents. That's pretty close. The next part, just like I did in class, I'm going to change something. So suppose the price of the call is $5.50, not $6.50. Exactly what I did in class for whatever option that was, Xerox. So if it's $5.50, so $5.50 definitely does not equal $6.48. And we're going to do something about it. So let's do exactly the exercise that I suggested in class. We'll go one minute over or 2 minutes over to do this one. So we're going to write it P plus S minus PVK minus C, and that should equal 0. And it turns out that it's 425 plus 106, 875, minus the present value of the exercise price, and what is that? 105 times 0.9966 minus 5.5. And what you're going to do is to take actions that mimic the signs in that equation, because put this all together and it equals almost $1. Okay, so write this with a positive cash flow. Don't write it as negative 98. It's just going to confuse things. We don't want to do an arbitrage transaction to lock in a loss. We want to lock in a profit. So this is a positive 425, which means that we're going to sell or write. And this is a positive also, which means a sell. This is a negative cash flow, which means we're going to lend or invest in the T-bill. And we're also going to buy the call. It's obvious that we should be buying the call, because what did I do? I dropped the price of the call from $6.50 to $5.50 to make it cheaper. So we should be buying the call. And the last thing that we're going to do is to set up the table that I demonstrated in class. So it's going to be action, now, S star less than K, and S star greater than K. Buy call, sell put, sell stock, and invest in T-bill, the PV of K. So now this equals minus 550 plus 425 plus 106, 875 minus 104, 643. Okay, we've already done that, and we know that this sums to 98. But I want you to make sure that it works, and I want you to make sure that you actually know the payoffs of these different positions. If the stock price goes down, the call is worthless. If the stock price goes up, it's S star minus K. If the stock price goes up, the put is worthless. But if the stock price goes down, the put is worth K minus S star. But we're selling, so it's minus the whole thing. The stock is going to be worth S star, and we have to pay that out, and lend the PV or invest in the treasury bill, the present value is K, we're going to get K at the end. No matter what the stock price is. And as a double check, make sure that we get 0 and 0. It's easy to make a mistake, and this is a way to pick up that mistake. So we did almost all the exam. Now, the exam, as I said, is going to be a little shorter this year. And also, you'll notice question number 6 deals with futures, which is not going to be on the exam. And also, given we didn't talk about futures today at all, I'm going to have to roll the hand-in time for the futures assignment up again, probably to the day after the lecture, a week from now. Okay, so don't worry about the futures assignment. Go through that very last question. It's just an application of an option, and it turns out to be an option on a foreign currency.